But
Tell
Chris,
you.
it's a pleasure to be with you, and it is a pleasure to be with all of you guys watching. I understand that this is a very trying time right now. It's a difficult time because there are so many uncertainties and things that don't make sense. You know, all of these things that we've come to know over time. The game's changed quite a bit, hasn't it? And the biggest fear, of course, is this nasty virus that we're all trying to get our arms around and understand. As a matter of fact, as you mentioned earlier, Chris, at 3 p.m. Eastern and noon Pacific, I have the head of the Cleveland Clinic, the very famous Mike Roizen, that I'm going to be asking a lot of questions and then trying to, based on his information, see how this kind of works with the housing market and with the overall economy. So I think it's important for all of us to first take a look and some of the issues that we're facing, and then try and figure out what to explain to our customers and how we could interpret this. Because let's face it, it wasn't very long ago that you might have been quoting somebody a rate around 3%, and now suddenly you might be above 4% in a really short period of time, while the Fed cut rates by 1% to the downside. So how does the Fed cut rates down 1%, and we're looking at rates that are higher by 1%, all in a very short period of time? Let's try and unpack it for you. So the first thing that we need to understand is that the Fed funds rate and mortgage rates are not the same thing. Fed funds rate, it's an overnight lending rate. It's a rate that one bank would charge another bank to borrow money in the short term. Why do they need that? They need that because when you put your money in the bank and you say, I'm giving you $1,000, that's a liability to the bank because they're borrowing it from you. They owe it to you. When you deposit money, the bank's borrowing that from you. Now, the bank's going to take most of that money and use it as far as investments and treasuries and loaning it out and doing car loans and things like that, so that they can make a spread. They can make more interest in what they charge, taking your money and loaning it out, than they're paying you to deposit it with them. That's how the banking system works. But the thing of it is that the bank can't use all your money. There's something called the Federal Reserve Act, which means they have to keep 10% of your money in the bank, and the rest they can lend out. So if a lot of people want to take back the money from the bank that they deposited, I need cash, the bank oftentimes has it, but sometimes too many people want to take out money and they don't have enough cash on hand. They see this coming, and they call other banks, and they say, hey, can you lend me money just overnight, short term, till things wash out? And that's the Fed funds rate. That's the target rate, which is now 0 to 0.25% in that range. And that's where they want banks to be lending each other money. It's very different than a mortgage rate because that's only out there for one day. Mortgage rates could be out there for 30 years. So certainly going to contemplate that over a lot longer time with a lot more things that can happen and influence where interest rates are. Because think about it, a bank doesn't want to give a loan out for 30 years at 3%, where if rates go to 4 or 5 or whatever, they'd lose money for 30 years on that deal. And vice versa, if rates come down, they've got to kind of contemplate what the difference in the changes are. So these two are very different things. And Chris, in anticipation of this, I have something that I'd like to share with you right now, if that's okay.
Please.
I want to show everybody the difference between the two, because as I share my screen here, I'm going to show you really quickly. Customers want a 0% rate, but let's take a look at these two lines. So you will see that there is a red line, and that's mortgage rates. And then you'll see there's a blue line, and that's the Fed funds rate. And Chris, I've got this all the way back into the 1980s because I wanted to show you, look at periods of time where the Fed hiked rates, mortgage rates came down. Fed hikes rates a lot, mortgage rates come down. Fed hikes rates or raises rates here, mortgage rates start trending down. And then when you see the Fed lowering rates, mortgage rates stay up there and actually go up. Fed lowers rates a lot during the dot-com bubble. Well, mortgage rates come down only slightly. Fed raises rates and mortgage rates actually come down. Fed lowers rates, mortgage rates go up. But as you can see, even with the Fed keeping rates for a long time at 0, which is where they are back to now, mortgage rates only slowly trended lower. So I'd like to show everybody that we are talking about two different things. This is right here, the Fed funds rate just the other day being cut on Sunday to 0, and mortgage rates, what we didn't see is the move in the last couple of days going up. Now, Chris, when we take a look at this and we say, okay, mortgage rates are different than the Fed funds rate, So at least we kind of understand that they're not correlated. So why in the world did mortgage rates go up so much? There's a few reasons for that. So a lot came from our Treasury Secretary, Steven Mnuchin, and he was giving a press conference, and he didn't mean it this way, but he said, listen, we have to come up with a package. We have to take action. And then he said these words. He says, if we don't do it, we're going to be looking at 20% unemployment. The market said, oh my goodness. Why is that so important? During the Great Recession, housing bubble, crisis, financial crisis, Great Recession, you all remember how tough things were. That was 10% unemployment. 10%. The Great Depression had less than 25% unemployment. So a 20% unemployment number is devastating. And in the credit markets, what that did is it now introduced another variable. And what is this new variable? What if people don't pay their mortgage? We have very low delinquencies. We have very, very, very low foreclosures. But what if we have 20% unemployment? The market is trying to price in what would this mean with this new risk? And this new risk is, are people going to pay? So just like anything, imagine it with a borrower. If the chances increase that the borrower may not pay, if you do the loan, what happens to the interest rate? More risk requires greater compensation. And that's part of what you're seeing. This happened instantly after Steven Mnuchin said this. Now, I'll give you my take personally. I think we are in for a little bit of a rough time here. I'll give you a breakdown, Chris, on the housing markets and the credit market. I'll give you that breakdown before we depart this call. But what I will tell you is I do not see it being as bad as far as the housing market goes due to the fact that there's a lot of equity in homes right now, and that is the saving grace right now. Okay, let's get back to our friend Steven Mnuchin, the Treasury Secretary, because part of what Steven Mnuchin was talking about and part of the plan to help people, and I get it, we certainly want to help people. Goodness, we want to help businesses. We want to help individuals. And you hear talk about everybody gets a check for $1,000. Businesses get a bailout. Well, as you would imagine, we're talking enormous sums of money. The Fed doesn't have a savings account in their checkbook where they could write it. The Fed has no money. The Treasury has no money. Our government has no money. What does it have to do to create these funds? Well, they have to borrow it. And the way they borrow it, the Fed borrows money by issuing debt. And by issuing debt means they issue treasuries. Now, we have been doing this forever. But when you issue treasuries at a pace that's reasonable, there's enough absorption. But what this shock and awe thing that the Fed is trying to do, the Treasury's trying to do, our government's trying to do.
We're talking about the treasuries and the disconnect of where we are right now in the marketplace. And by the way, I just want to say this is on my end, so I apologize, Barry, for the interruptions.
It's okay, it happens.
It's okay. But and again, just for those that are watching, again, I've got realtors on this call. We have mortgage professionals on this call. We actually have consumers on this call. And so, Barry, I appreciate the fact. And for those that don't know you, because again, there are realtors and just the consumers that are on this call that may not know you. I do just want to say this: Barry Habib is worth listening to. He is. Everyone's heard of Zillow. Zillow puts out an award, and they have awarded him multiple times, most recently 2 times in a row, as the most accurate economic forecaster in our space, bar none. So he's the twice winner of the Crystal Ball Award. He's, on a fun note, he's the producer and creator of Rock of Ages, and even starred in his own movie there. So just, you are a very, very famous individual, but what is so great about you is you are extremely humble. And something else I want to say very positive about you. Many people are asking you, hey, can we please pay you to come and do what you're doing right here? And you refuse to take any money, and that's because you care so much about your country, your industry, and you're just a good human being. So
thanks, man.
Thank you for all that you're doing here.
Well, thanks. This is bigger than everybody right now. We just got to pull together and do this and just do what we can. So I'm just trying to do my part and explain what's going on to the best of my ability and make it a little bit easier for us. So just to get back to a little bit where we are, I'm going to share my screen again. I want to just show this here just to make sure we're all caught up. As you can see, mortgage rates in red, the Fed funds rate here, and you can see that there's definitely a distinct difference between the two. Interest rates from the Fed shoot up, mortgage rates go down. Fed rises rates, mortgage rates come down. You can see the Fed drops rates, mortgage rates don't come down that much. A little bit, they go up and down here, and vice versa. And then you see this big drop by the Fed here. Mortgage rates don't do too much. And mortgage rates don't respond either when the Fed shoots rates up right here. And you can see here when the Fed put rates down to zero after the dot-com bubble and kept them there for a very, very long time. I'm sorry, this is the Great Recession. This was the dot-com bubble, this is the Great Recession, and kept them at zero for a very long time. Mortgage rates did come down a tiny bit, but not that much. And then they didn't really respond that much when the Fed started hiking rates. Now, look at this big drop here, and what we haven't seen is mortgage rates going up. So why? Why are mortgage rates going up? Well, there's a couple of different reasons. Well, number one is the fact that our Treasury Secretary, Steven Mnuchin, he meant to do good and tell the public that we need to do something. We need to do something now, and kind of imploring on the Treasury and Congress to come up with a plan. And when he said publicly something like this, he said, if we don't do this, unemployment will reach 20%. Now, 20%, that's depression-like numbers. Even during the Great Recession, the financial crisis, the housing bubble, unemployment reached about 10%. So 20% would be devastating. And this introduced a new variable, and that is, well, are people going to pay their mortgage? So if that puts greater risk on the mortgage market, investors need greater reward. So therefore, in any market, anytime risk is elevated, reward has to be commensurate. So that caused interest rates to rise. But then Steven Mnuchin, when we started talking about packages and plans, was talking about some very big numbers. Now, I get it. You want to help people. Businesses need help. Individuals need help, because we're just getting to the beginning of this. And while these businesses are being closed, maybe some of them are nice and they're paying people, but how long can they continue to afford people? How long is it until individuals no longer are receiving a paycheck? They're going to count on some aid from the government here. And if that does happen, then these are enormous debts that the government will get itself into, because the government doesn't have a checkbook. They could write it out. They have no money. For them to provide trillions of dollars in bailouts and aid and assistance, for them to do that, they have to borrow it. And the way they borrow it is by issuing treasuries. And then you just have your economics 101, Chris, where so much debt will be on the market, so much in treasuries comes on the market, and the market's saying, hold on a second, how are we going to absorb all this? We always get into debt, and debt's increasing, but it's incremental and it's gradual. And as they put out debt, it gets absorbed, and that's okay. But when you've got all this debt and it's difficult to absorb, you have to provide, just like anything else, anything that there's too much in supply and there's not enough buyers, the price drops. So remember, we're talking about bonds here and treasuries. As the price drops, it means the yield or the interest rate goes up. And as treasury yields rise to this, mortgage rates follow, and that's what you're seeing. And there's something else too, Chris, that's important for us, and that's sheer volume levels. And right now, when you think about the size of the mortgage industry, it's $11 trillion that people have mortgages, right? The size of the mortgage debt is $11 trillion. And I did some math with my son, Dan, and we figured that there were, at one point, about $5 trillion of mortgages that were eligible to be refinanced. It's a reasonable guesstimate. Mm-hmm. And in a good year, Chris, as you know, our mortgage industry as a whole can facilitate about $2 trillion, maybe $2.5 trillion. Who knows? Maybe we go crazy and it's $3 trillion in a year. Half of that's purchases. So you get about $1.5 trillion of refinance. Maybe let's say $2 trillion, or let's go crazy and say $2.5 trillion of mortgages that can be done in an entire 12-month year. You can't get $5 trillion done in 2 months or a month. You can't. So this was causing capacity issues at the worst time. This virus comes, and now people are being sent home to work from home. You know they're not going to be as productive. They want to be, but you just aren't. And that makes it even more difficult. So when we kind of combine all of these things to throw a cherry on top, the stock market, rightfully so, declines precipitously. And Chris, you know, I'm very proud of this. I wish I was wrong, but when every person was coming on CNBC saying this is going to be blow over, this is nothing, don't worry, buy stock for a great opportunity. You know, there was so many stockbrokers who called me, Chris, and said, oh, every signal I'm getting is turning green, everything's fine. I said, don't you dare go into the market and put your clients at that. This is not over. When it was at the S&P reached 3,400. When it was at 3,200, I gave a crazy number, said it on Fox, 2,350 on the S&P, which everybody thought I was absolutely insane. Every top analyst thought I was insane. 2,350. Nobody was even thinking about that in their wildest dreams. Well, guess what we hit yesterday? 2,350 on the S&P. We actually dipped beneath it. I know you're going to have these bounces, and every time there was these big spikes, as you know, Chris, I told everyone, these large spikes, I learned this lesson a long time ago, are not a sign of a bull market. Large upward moves in the stock market are signs of a bear market, not a bull market. It was a lesson that I learned many, many years ago, and it is so true. It's a valuable lesson for all of us. Is the selling over in the stock market? I unfortunately don't think so. Listen, nobody knows for sure. I could be wrong. And I know many of you have your portfolios and savings and stocks, and you're thinking, I am worried here. I saw what the value was at the beginning of January when the S&P was at 3,400. Now, maybe I've lost a third. Maybe depending on what you're invested in, you've lost more than that in value. Where is the bottom? What I will tell you is this. Longer term, I think you're going to be just fine longer term. I understand this is painful to go through, but I will give you a number that I think probably is a very good floor. I hope we do not hit that level. I hope we don't. But this is what my gut tells me is about 1810 on the S&P, which is significantly lower than we are now. What could change that? Well, a very promising result that gets out there with drugs, a flattening of the curve more rapidly. People start to get out and work, and businesses reopen more rapidly. I just think it might take a little bit more time than that. This is just my gut. I am certainly not 100% in the know here at all. I'm giving you what I think, but I feel that would be commensurate with almost a 50% drop. 50% from the peak would be 1,700. And pretty much during recessions, and that's what we're in right now, just like I'd forecast, during recessions, you get about a 50% drop in the stock market. Chris, you remember I spoke to your group live, and I told them that during recessions, things drop, and that's why I want you to personally be careful, because when you start to enter recession, you can see a 50% drop in the stock market. Mm-hmm. And this is, unfortunately, what I think we might be close to looking at right here as far as stock prices go.
So can I ask you a question, Barry?
Yeah.
All right, so the ripple effect, obviously, we see, and that's part of why we're going to see the recession. The people, Vegas has gone dark. All these union workers, we're seeing contracts obviously cancel out there. How fast of recovery, depending on if once this 2 weeks is over, that the president said, hey, everyone sit tight there for 2 weeks. Once, I know you're shaking your head no already, but once this is over, is this going to be extended? And I mean, yes. Nobody knows for sure, but you've had some great conversations, obviously. And again, I would recommend everybody be on your call at 12 Pacific and 3 Eastern, Facebook Live. Just go to your page, correct?
Yeah, NBS Highway, just the open page. It's something we usually do stuff like that for our subscribers, but this is bigger than us. We just want the general public to know, because when you get a chance to ask the head of the Cleveland Clinic questions about, is it going to affect my blood type? What are the risks? What are the things? I mean, I've learned so much about coronavirus from him, and there's a virologist, a top laboratory scientist that I've been in close contact with, and trying to get the information out to people in a way that we can understand it. I think this will be a good call where you can actually ask questions. So we thought it was much bigger than us. Let's just get it to everybody to help everybody.
Well, you have okay. So if with the time I have left with you, if we can talk about liquidity, we're seeing obviously non-QM lenders who are now hitting the pause button on even doing business. Period. We're seeing Redfin announce that hey, we're no longer going to be buying homes. There's a lot of announcements that are coming out minute by minute, and it does kind of feeds on itself, of course. And we want to be as positive as we possibly can, but there are some realities here that we all have to face.
Yeah, this is a time to be realistic. And so here's what I think. I just told you what I think about the stock market. So let's go stocks. Let's go interest rates on mortgages, and let's go to the housing market. So we'll give an overview of the economy, and this 2 week notion is really difficult to get our arms around. I pray to God it's 2 weeks. I pray to God it's 2 days. I pray we come up with a miracle cure right now. There are drugs out there right now that are promising, that are helpful, because one of the deadly aspects the reason why people are dying from this who are older is because you develop plaque as you get older within your arteries, and part of the problem that this virus creates is that when the inflammation occurs from the virus, there's plaque that breaks off, and that's when you can get the nasty stuff that happens when plaque goes and clogs a vital part of your blood flow. It's I don't want to talk about it because people that are a little bit older or have developed plaque, and many of us have. This is important that we find a way to stop this. So when you take a look at medications that were effective in slowing the immune response, like this malaria drug that is out there right now that is already approved, that we want to see if it gets into the hands of individuals, that's promising. But I don't think in a week you're going to have people hugging and kissing in the streets openly anymore, or restaurants open, or people. I think this is going to take a toll, and I think the numbers that we will see will be pretty awful as far as economic activity in the interest rate environment, in the mortgage environment. Yes, this will be a strain, clearly. I think interest rates, until this shakes out a little bit more clearly, we will see interest rates elevated a bit to try and compensate or contemplate, I should say, for the potential additional risk. That's a natural thing to occur. But if you were to say maybe it's 6 months, maybe it's 3 months, or whatever, when we start to see some recovery, some steps back to normal, we will begin to look back at where we were before this. Where we were before this was interest rates were very low, interest rates were trending lower, but I do think that this added debt that we're being put into because of these programs, depending on how far out of hand they get, will cause more supply on the marketplace, which will give interest rates a little bit of more elevated than natural state. I still think interest rates will be good. I still think that you'll be able to do some great things, especially with a very important element, and that is debt consolidation. It really almost doesn't matter if rates are higher by the good you could do with debt consolidation. Finally, housing market, Chris. The housing market is going to take a bit of a hit here in the short run. Because let's face it, on the activity side, do I want to go potentially to look at a home that could be possibly infected? Or if I'm selling a home, do I want people traipsing through here who could bring infection into my home? This is going to be a big challenge. But there is still much more demand for housing than there is supply. We still have a very strong and healthy housing market. That will be one of the first things that you will see recover. As we feel more safe and more secure about being out and getting in the social environment, housing will be one of the first things that will turn up, because it's not like you got to ramp up a business or start hiring or start restocking supplies or this. You just turn that on and that thing starts to cook. So as far as housing goes, that's the good thing. And to the extent where you can, this is not a time to maybe take unnecessary risks, but to the extent that you can, you could probably get some good deals on housing during this period of time, because in the past, Chris, people were looking for a home and they were getting outbid. There was no inventory. Perhaps this could be an opportunity, but please be cautious. Please be careful. Please be safe. That above everything else.
It's interesting you said that, because you think about what Warren Buffett's always telling everybody and teaching everybody, and that is obviously
greedy when others are fearful.
There you go. And so do the exact opposite of what the crowds are doing. Can you just expand a little bit? I use the expression, I know I've got a limited time because you've got another call you have to be on, but one of the things that's occurred, as I said, in the non-QM. Now, for those that don't know, maybe you can just kind of explain the qualified mortgage versus the non-qualified mortgage, and why is that money drying up all of a sudden, by and large? Literally just in the last 24 hours.
Well, because for many instances, those transactions are not as good a risk than some of the loans that would be lower ratios.
So nobody's buying them from the investor side of the secondary market.
Because there's slightly greater risk as far as those are concerned. So a hit to the economy here. Somebody whose ratios are already stretched, Chris. That person loses their job. That's a riskier loan. I think it's more of a concern of risk than anything else.
Well, any parting thoughts, Barry? There's no crystal ball, obviously, no pun intended, even though you're the award winner of that. There's no crystal ball for sure to say what's going to occur. And I know that you've got your call that's coming up at 12 o'clock Pacific that's going to be talking about the coronavirus. I'm imagining anything you want to tell us about that call that's going to be coming up?
Well, yeah, like I said, Mike Risen, who is, he's a very famous doctor. He does so much work with Dr. Oz. I am blessed that he's a friend of mine. He's Oprah Winfrey's personal physician. I mean, this guy is just, and he's a prince too, and he's super smart and he's super easy to talk to. I have a lot of questions from him because there's just not enough information, Chris, as far as, what's the real risk? How susceptible? Is this like measles where 90% of the people you come into contact, you get it? Or is this more where it's like 10%? How can I make sure my immune system is as strong as it can possibly be? What is the initial symptoms? I mean, listen, Chris, I got this thermometer and I go around doing this to my head to make sure I'm okay. And I do it to people. I'm 98. This is my temperature right now, so I'm running okay. So I do this around the office too, where we're trying to monitor this. But the scary thing about this virus is that it can be contagious without you really presenting symptoms. And I know he's talked about this. I mean, there's other ways that it's transmitted where, washing your hands, it's really serious that you do this, but he's going to help us understand this and unpack this. How does my blood type affect my susceptibility to this? What are the dangers in different age groups? How long does it take to get better? Once I'm better, is it something that now I'm protected and immunized from? There are other viruses out there like chickenpox, which later on causes shingles. Is this in that category? Does it live on your nerve endings like AIDS or herpes or something? These are very important questions that the general public just is not getting information on. And I happen to know the answers to these from Mike, but Mike will share all these things with everybody so that they can understand. And in understanding, we can cope a little bit better. But my parting thought is that this is an easy time to get frustrated. You can get cabin fever. You can get frustrated about loan processing. You can get frustrated as a consumer that maybe you missed your lock or maybe you thought you missed your window. And there's so many things that we can get frustrated about. But I want to tell you that this is not the time for that. This is the time to show your true character. This is the time where you really have to rise above all this, be good to each other, be patient with each other, be kind to each other, and just understand that these are crazy times. No one's trying to do any harm. No one's trying to do anything bad. This is just a difficult time for all of us. And while we will get through it, there's going to be a few weeks here of uncertainty. There might be a couple of months of some economic activity that's difficult to deal with, but the recovery will come and the recovery will be terrific. We just have to keep a longer-term mindset and not just focus on the short term, although we need to be vigilant and safe during the short term.
Do you have, you can say no, do you have time for just a couple of quick questions?
Sure, go ahead, yes.
All right, so question number one says, where are rates going to be in the short term for the next 30 days? Any prediction you want to give us on that?
Well, tell me where the virus is going to be in the next 30 days. That's not really a question that you really should be focused on. How do we know that? We are so dependent right now on where this virus goes from here. How does the spread go? What is the economic impact? How much paper is the Fed going to put out there? So those are bigger questions that need to be answered first before we could start to contemplate where interest rates will be. As I said earlier, it looks to me that interest rates will be elevated because the anticipation that this paper is coming out, because of the fact that we have unforeseen or unquantifiable risk in that, is this impact going to cause people to now line up for unemployment in very large numbers, and now maybe that means mortgage payments start to fall behind? These are tough questions, and I get it from your standpoint. I understand you're focused on where that is for your business or your customer. I get that, but there are bigger things that we have to figure out first, and the others will shake themselves out. They might take a little bit of a longer period of time, but they will. But there's too many uncertainties. But if I were to say, I anticipate rates are going to be elevated for a period of time.
And probably the same answer would be, it says how long do you think before the coupon improves for FHA loans? Same answer?
Same answer, guys.
Same answer.
Just they're going to be elevated for a period of time. How long is the virus going to be a problem? How much money is the Fed going to pump in? These are things we have to think about first, and then we just don't know.
Somebody asked, again, this is, so someone says, so people shouldn't bail out of their stocks they own, just hold on, and just long-term, You think?
Long term, I agree with that strategy. Okay, I think that you should talk to your financial professional. I can't give you advice. What I will tell you is that for me personally, and I heeded my own advice when I thought at 3,200 it was look out below, and I don't think that at this level, even though it hit my initial target, that we have seen the numbers start to come out that I think are going to be very, very troubling. And I think that the stock market will tend to price that in, and I see it getting worse before it gets better. But I agree with what the person who wrote that question in, is that in the long term, if you have long term ability, I think you'll be just fine. I think it will come back at reasonably good levels, but I think it gets worse before it gets better. And I think that it's not unreasonable to think that 1810 on the S&P isn't within the possibility of seeing that first.
There's a bunch of questions from people asking about, well, Barry, do I lock my rate? Do I not lock my rate? And here's what I would tell everybody watching me. This is not a commercial, obviously, for MBS Highway, but Barry happens to be the founder and creator of MBS Highway, which I swear by. And so if you want to subscribe or team up with somebody who subscribes with MBS Highway, you'll be able to get the information on whether you should float or lock on a daily basis.
So Chris, let me just show something here so everybody can see. This is live mortgage-backed security pricing. So we had done one rate lock in 2020 up until this date right here. When was that? That is up until March 9th. One rate lock. And where did we lock? Right there. Does that look like we locked at the best pricing you can get? And then certainly since then, lock, lock, lock. So you can see we have done a series of rate locks since then, all at the peaks to protect you. But I'm very proud of this because we took all of these gains without locking in and locked right there for everybody. So while you might not have everything settled in, we've tried to warn you. So when should you lock? My advice would be to lock when we tell you to lock. So that's what you should be doing.
Barry, I want to keep my commitment to you. You were so nice to be able to jump on here. I called you on a Sunday afternoon, and you immediately said yes. Since then, I know you've been bombarded with a similar request, and you can't serve us all, but just thank you for
Chris,
what you do for all of us.
I love you. You're a dear friend. I love your teammates there. You are a wonderful human being, and you've got a heart of gold, and I know that what you're trying to do here is do your part and do good for others. So
Absolutely.
Anything that I could potentially do for you can always count on me. I love you. Thank you.
All right. Love you guys, too. Thank you very much. All the teammates there that listen over at MBS Highway, Nicole, Dan, everybody, thank you guys. Barry, have a great one, and see you at noon Pacific time.
You got it, brother. Bye.
All right.